Accounting is often regarded as the language of business because it provides a structured method for recording, analyzing, and communicating financial data. The accounting cycle is a fundamental process that serves as the cornerstone of financial reporting for businesses and organizations. In this video, we will delve into the accounting cycle, its essential steps, and the significance of the accounting cycle. The accounting cycle comprises a sequence of well-defined and interconnected steps that accountants and financial professionals follow to record, process, and report financial transactions. It offers a systematic approach to ensure that financial data is accurately recorded, and that financial statements, such as income statements and balance sheets, are prepared consistently and promptly. The accounting cycle usually covers a specific period, such as a month, quarter, or fiscal year, depending on the reporting requirements of the entity. Let's discuss key phases in the accounting cycle. Number 1. Transaction identification. The initial step in the accounting cycle involves identifying and analyzing financial transactions. These transactions can encompass sales, purchases, investments, loans, and various other financial activities. Accountants must determine which accounts are affected by each transaction, and whether it results in an increase or decrease in the account balances. 2. Transaction recording. Once transactions are identified, they are recorded in the accounting system using a double-entry accounting method. This means that every transaction impacts at least two accounts, with one account debited and another account credited. This approach upholds the fundamental accounting equation: assets equals liabilities plus equity. Number 3. Posting to the general ledger. Transaction data is subsequently posted to the general ledger, which serves as the primary accounting record containing all the accounts used by the entity. Each account in the ledger is updated with the appropriate information from the transactions. 4. Trial balance. After all transactions are recorded and posted, a trial balance is prepared. This is a listing of all the ledger account balances, both debit and credit, designed to ensure that the accounting equation remains in equilibrium. Any discrepancies indicate errors in the recording process. 5. Adjusting entries. Adjusting entries are introduced at the end of the accounting period to account for accrued revenues, expenses, and other items that may not have been recorded during the regular transaction recording. These entries guarantee that the financial statements accurately represent the company's actual financial position. Number 6. Financial statements. Following the creation of adjusting entries, financial statements are prepared. The primary financial statements encompass the income statement, illustrating revenues and expenses, and the balance sheet, which presents the entity's assets, liabilities, and equity. 7. Closing entries. At the conclusion of the accounting period, temporary accounts, such as revenue and expense accounts, are closed, meaning their balances are transferred to the retained earnings account on the balance sheet. This procedure resets these accounts to zero for the new accounting period. 8. Post-closing trial balance. After closing entries are executed, a post-closing trial balance is compiled to verify that all temporary accounts have been appropriately closed and that the accounting equation remains in balance. If you find the video helpful, please like the video. That will be helpful for this channel. Now come to significance of the accounting cycle. The accounting cycle holds significant importance for following reasons. Accuracy. It ensures the accurate recording of financial transactions and the faithful representation of the entity's financial position in its financial statements. Consistency. Following a structured accounting cycle fosters consistency in financial reporting, facilitating comparisons of financial data across different timeframes. Transparency. Well-documented and organized financial records enhance transparency, simplifying audits, compliance efforts, and earning the trust of stakeholders. Informed decision-making. Timely access to accurate financial information generated through the accounting cycle is imperative for effective decision-making by both management and external stakeholders. Conclusion. The accounting cycle stands as a crucial process in the realm of finance and business. By adhering to these systematic steps, Organizations can uphold dependable financial records, generate precise financial statements, and make well-informed decisions. If you want to read it in details or download the PDF, go through the link in the description, and don't forget to subscribe to Educationleaves.